Imagine waking up one morning, scrolling through your phone with a casual swipe, only to freeze when you see that the value of your tech stocks has plummeted overnight, thousands of dollars gone in mere hours. It's not just numbers on a screen. It feels like watching part of your future evaporate into thin air. That sinking feeling in your chest, the sudden rush of panic mixed with disbelief, it's something I know all too well because I've been there. I remember vividly the night before those losses hit hard. I was confident, optimistic even. The tech sector was booming, or so everyone said, and every headline promised that this wave would keep lifting us higher and higher. Buying those shares felt like stepping onto an escalator destined for the top. No risk involved, just a steady climb upward. But then reality came crashing down faster than any news cycle could update me. Suddenly, my portfolio wasn't a symbol of smart growth and future security. It was a lesson carved out in red ink and sleepless nights. What struck me most wasn't just the money lost, but how unprepared I had been. Not emotionally, not strategically, to handle that blow. It forced me to confront some harsh truths about investing in tech stocks and about myself. My assumptions, my fears, masked as confidence, my tendency to chase hype instead of understanding fundamentals. That experience became a turning point, a crash course paid for with real money rather than textbooks or advice from self-styled gurus promising guaranteed returns. What did losing money teach me? It taught me patience where there was once impatience, discipline where impulsiveness ruled, humility where arrogance had taken root. More than anything else, losing money drilled into me the importance of knowing what you're really buying into. The companies behind the ticker symbols, and recognizing that innovation doesn't always translate into immediate profit or invulnerability. If you've ever felt overwhelmed by market swings, or wondered why some investments fail, despite all signs pointing otherwise, this story might resonate deeply with you, because it's not just about numbers falling. It's about learning resilience and gaining clarity amid uncertainty. And while nobody wants to lose money willingly, sometimes those losses hold invaluable lessons that no success story can ever teach as profoundly or personally as failure does itself. So let's dive into what happened next, how facing that loss reshaped my approach to investing in life in ways far beyond financial statements alone. When I first watched my tech stocks plummet, it felt like the ground beneath me had vanished. Imagine putting your faith and a chunk of your savings into companies that promise to revolutionize everything from communication to healthcare, only to see those promises evaporate overnight. It's more than just numbers dropping on a screen. It's hopes and confidence taking a hit. One example that sticks with me is when I invested heavily in a startup developing cutting-edge AI tools. The tech sounded foolproof. The market was buzzing, yet within months, regulatory hurdles and fierce competition crushed their valuation. At that moment, I realized how little control we truly have over external factors. But here's what losing money taught me beyond just don't put all your eggs in one basket. It forced me to rethink what success means in investing and life itself. Instead of chasing quick wins or getting caught up in hype cycles fueled by headlines and optimism alone, I learned the value of patience and due diligence, the kind you don't rush through because of FOMO or pressure from others. Practical case. After that loss, before buying into any new stock, I started dissecting financial reports with fresh eyes. Not just looking at earnings, but understanding cash flow stability and management integrity. Facing loss also revealed my emotional blind spots. Fear made decisions impulsive at times, while greed tempted me back into risky waters too soon. Recognizing these patterns was crucial. It transformed investing into an exercise not only of strategy but emotional discipline. That shift didn't happen overnight, but grew steadily as I treated each failure as feedback rather than final judgment. Ultimately, losing money in tech stocks reframed my entire relationship with risk. It became less about avoiding failure at all costs, and more about embracing uncertainty thoughtfully and learning continuously along the way. When I first dove into tech stocks, I was captivated by stories of overnight millionaires and sky-high valuations. But real life wasn't so kind. It hit me with sharp drops and unexpected twists that no flashy headline could prepare me for. One moment, a company's stock would soar on the promise of innovation. The next, it would plummet because that promise didn't materialize as expected. I remember holding on to shares of a once promising startup whose technology seemed revolutionary but struggled to gain market traction. Watching my investment shrink day by day was painful, yet it taught me an invaluable lesson. Hype doesn't equal certainty. This experience reshaped how I evaluate opportunities. Instead of chasing the next big thing, I began digging deeper, studying business models, understanding competitive landscapes, and assessing leadership credibility before committing my money. It's like dating. Initial attraction is easy, but building trust takes time and observation. For example, when another fast-growing firm faced regulatory hurdles that tanked its stock price, many panicked and sold immediately. I didn't sell then. I analyzed if these challenges were temporary or fundamental flaws in their strategy, and waited patiently as they adapted successfully over months. More importantly, losing money forced me to confront emotional biases that cloud judgment. Fear pushing me to sell too quickly or greed tempting risky bets without proper research. Recognizing these tendencies helped me develop discipline, a mental checklist before every trade, to avoid impulsive decisions driven by headlines or social media frenzy. In hindsight, those losses weren't failures but tuition fees for mastering the complex art of investing in technology companies where innovation meets unpredictability. They taught me resilience, the ability to learn from mistakes rather than be paralyzed by them, and patience to let long-term value unfold despite short-term noise. If there's one takeaway here, it's this: embracing uncertainty thoughtfully means preparing yourself, not just financially but mentally, to navigate volatility with curiosity instead of dread. A mindset shift worth far more than any portfolio gain alone ever could provide. What I realized after those painful losses is that the market doesn't owe you anything. It's indifferent to your hopes and fears. When I first bought those tech stocks, I was seduced by stories of overnight success and exponential growth. But reality hit hard when a single earnings report or a regulatory announcement wiped out weeks of gains in a matter of hours. It forced me to confront something crucial. My emotional attachment to the numbers was clouding my judgment. One day, for example, I held onto shares of a promising startup because it had potential, despite clear signs that competitors were outpacing them technologically and financially. That stubbornness cost me dearly. If I detached myself emotionally and evaluated the situation objectively, I could have cut losses earlier and redeployed capital more effectively. Another lesson came from diversifying beyond just what's trendy or hyped. After losing heavily during a tech sector sell-off, I began exploring companies with solid cash flow and durable competitive advantages outside the usual Silicon Valley sphere. Think utilities or consumer staples that rarely make headlines but provide consistent returns. This shift didn't mean abandoning growth entirely. Instead, it balanced risk with stability so downturns in one area didn't devastate my entire portfolio. I also learned the value of patience paired with curiosity. Instead of panicking at every dip, I started investigating why prices were moving. Was it temporary noise or fundamental change? For instance, during one slump involving cloud computing firms, digging into their earnings calls revealed strategic pivots rather than failures. That insight gave me confidence to hold through volatility until markets recognized their real worth again. Ultimately, losing money taught me humility, not as defeat but as an invitation to grow wiser about how markets operate and how emotions can sabotage even the best intentions if left unchecked. It transformed investing from a stressful gamble into an ongoing journey where learning becomes your most valuable asset. One of the toughest lessons I learned after those losses in tech stocks was just how easily fear and greed can hijack your decisions. Let me put it this way. When Apple's shares suddenly dipped back in 2018, my initial reaction wasn't calm analysis. It was panic. I remember staring at the screen, heart pounding, tempted to sell off everything just to stop the bleeding. But then I paused and asked myself, what am I actually reacting to? The stock price or my own anxiety? That moment made me realize that investing isn't just about numbers. It's deeply psychological. Consider another example. Tesla's roller coaster ride between 2019 and early 2020. Many investors jumped on board during its meteoric rise, but some held on through terrifying drops because they believed in the company's vision despite market chaos. Those who could detach their emotions from short-term volatility often came out ahead. It taught me that understanding a company's fundamentals and long-term potential can anchor you when wild swings hit. I also saw firsthand how chasing the next big thing without thorough research leads straight into trouble. Remember when everyone was hyped about a certain cloud startup promising revolutionary AI solutions? I got caught up in the buzz, investing heavily without digging deeper into their financials or competitive landscape. The result? A steep loss as reality didn't meet expectations. What shifted everything for me was embracing patience and discipline, waiting for opportunities rather than reacting impulsively, and continuously educating myself about market trends instead of following hype blindly. Investing became less about quick wins and more about steady growth fueled by informed choices. So here's what you might take away. Don't let emotions be your guidebook. Let curiosity and critical thinking lead you instead. Losses sting, yes, but they're also powerful teachers if you're willing to listen closely and adjust your approach accordingly. What I want you to take away from all this isn't just a story about losing money in tech stocks. It's a reminder that every financial setback carries within it the seeds of growth and transformation. When I first plunged into the world of technology investments, I was blinded by the dazzling promise of innovation and rapid gains. But what I didn't realize then was that behind those headlines and soaring charts lurked volatility, unpredictability, and lessons disguised as losses. Each dip in my portfolio wasn't merely a number shrinking on a screen. It was an invitation to look deeper, to question my assumptions, and to develop resilience. You see, losing money taught me more than any win ever could, because it forced me out of complacency. It pushed me beyond blind optimism into disciplined analysis, where curiosity wasn't just encouraged but essential, and where critical thinking became my compass amid market noise. Reflecting on those experiences now, I understand that embracing uncertainty is not a weakness, but a vital strength in investing, and in life itself. The tech sector evolves at breakneck speed, driven by innovation cycles that can both create enormous wealth and wipe it out overnight. This reality demands we become perpetual learners, rather than passive spectators. Losses sting deeply because they challenge our confidence, yet if you let them teach rather than defeat you, they will hone your judgment and sharpen your instincts for future opportunities. More importantly, this journey illuminated how important it is to balance enthusiasm with skepticism, to celebrate breakthroughs without ignoring risks lurking beneath the surface hype. Investing isn't about predicting winners perfectly. It's about managing risk intelligently while remaining open to new possibilities shaped by emerging technologies. So when you face setbacks, whether in stocks or any pursuit, remember, these moments are not endpoints, but crossroads inviting reflection and adaptation. Let your curiosity lead you down new paths instead of clinging rigidly to past mistakes. Allow critical thinking to be your guide through complexity, rather than relying solely on hope or emotion. And above all else, recognize that true success lies not just in accumulating wealth, but in cultivating wisdom born from experience. The kind of wisdom that empowers you to navigate uncertainty with courage and clarity. If there's one final thought I want you to hold on to, don't fear loss. Learn from it passionately, adapt relentlessly, and keep moving forward with open eyes and an open mind. Because sometimes the greatest returns come not from immediate profits but from the knowledge gained along the way. The very knowledge that transforms setbacks into stepping stones toward lasting growth.